I'm joined by James Ferguson, who's head of strategy at Arbuthnot Securities. Barclays earnings, why irrelevant, James?
All banks' earnings are irrelevant when we're in a post-banking crisis resolution period, when we're concerned about the balance sheet. This is a balance sheet crisis which needs to have balance sheet solutions. And talking about whether income statement P&Ls are beating or not analysts' assumptions when you've got these giant unknowns that come into each quarter. For example, in Barclays' case, the profit in this quarter was less than the improvement in the value of their own debt, which of course reflects the aggression with which the bond market was selling their debt. So we've got some very strange variables in here, and largely because, as I said, they're irrelevant. It's the balance sheet we need to be talking about.
So what about the outlook? What does this mean going forward? What are you watching for when you think about the European banking regulator, the capital shortfalls that the banks have to make up for, and then, of course, Basel III, but that will come later on?
Well, the thing we want to do, and I think the regulator wants the banks to do, is to earn their way out of trouble. It's a lot easier than coming up with capital, particularly now that equity markets are a lot less compliant. And so, therefore, we want them to earn their way out of trouble, and we want to create an environment where they can do that. But it's proving very difficult. You steepen the yield curve, but net interest margins still don't pick up. The big improvement in profits that the banks had last year was they were lowering the rate at which they were doing loan loss provisions. Doesn't mean there aren't less loan loss provisions there, they're just lowering the rate at which they were provisioning. And that's a concern going forward as well. And now, of course, the latest gig is that the biggest impact by far on profits is coming from the upward revaluation of their debt, because their debt has fallen so much in value. This is not a real profit, and it's not the sort of thing that we can actually use.
You're talking about the debt valuation adjustments,
absolutely,
the accounting practice that many banks are using now, which effectively inflates the profit on their balance sheet.
Yes, but it's not a profit that we can really use to sort of offset against and realise losses from the balance sheet. So this is not a profit that helps our balance sheet problem at all. So we're still looking at this intractable balance sheet problem. And this is what this is why the shortfall and what the EBA is doing. The EBA is saying all these European banks might have problems in terms of their risk assets. Let's ignore all that. They might have problems in terms of their risk-free assets. Let's ignore all of them except Greece. They might have problems with their Greek sovereign debt that might mean a haircut of 75 to 85%. Let's ignore half of that. Only look at 50%. So when the EBA says no one needs, or no UK banks need any capital, and everyone else only needs 100 billion, they're saying they only need that based on the assumption that out of our whole universe of losses, we lose nothing on risk assets, nothing on any risk-free assets, and only half of what we expect to lose on Greek.
So you're saying that actually UK banks will be more severely affected by events in Europe than we're currently anticipating?
For example, in the CDS market, we don't know exactly which banks have written all the CDS contracts, but just say, for example, that you were a bank that had written a CDS contract on a sovereign bond that actually then showed a loss. That bank, might then have to be good for the CDS contracts. So there's all sorts of levels at which banking across Europe and across the world now is interlinked, beyond the very simplistic, straightforward one of who owns that bond.
But you're also talking there, James, about a lack of clarity.
Well, the lack of clarity is important if the clarity would give you a very uncomfortable message. So the regulator now has changed sides. The EBA and the other regulators, Basel, are not on our side at the moment in terms of pointing out what the situation at the banks are, because they don't think that any of us would enjoy what we're seeing. So they're buying the banks' time.
So we don't know, is what you're saying?
Yeah, as I said in the film The Few Good Men, the truth, you can't handle the truth.
Okay, I just wanted to ask you about investment banking profits. I mean, obviously at Barclays it took a bit of a hit, but there was this anticipation that third quarter for investment banks was going to be a tough one. Has it been, when you look at how the US banks have done, we've had a couple of European banks as well, Deutsche Bank, UBS, and then many more this week. Has it been as bad as you expected? A little bit better?
I mean, I'm not a banks analyst, so I don't actually have fixed ideas in my head as to whether this will be a good number or this will be a bad number. But I definitely think there's more scope for investment banking to pick up in the medium term. We've got very, very strong corporate balance sheets. Corporates are doing very well. They've got great cash on the balance sheet, great profit margins, and in that environment, without this increase in aggregate demand, it makes sense that instead of doing capex, they would go out there and do more M&A. So I'm surprised there's been as little M&A as there has been.
So actually, you're saying that there is room for this industry to flourish rather than shrink or be scaled down, as many analysts are saying right now.
Yeah, absolutely. I mean, if we can get through this, and we will get through this, it's just that historically it takes time. It takes years. It takes sort of 5 or 6 years, and we're 3 years in if you're a British bank or a US bank, and we haven't started yet if you're a European bank. But by the time we're done, we'll be great. Citigroup, we already reckon that Citigroup is effectively through the worst and is up over 50% since we said so.
All right, so thanks very much indeed. Good to talk to you. Thanks for coming in with the long-term view. James Ferguson, Head of Strategy at Arbuthnot Securities.